Accounting systems. Learning objective. Discuss the significance of accounting systems in generating reliable accounting information and understand the 5 components of internal control. Information systems are critical to the production of quality accounting information on a timely basis and the communication of that information to decision makers. While there are different types of information systems, they all have one characteristic in common: to meet the organization's needs for accounting information as efficiently as possible. An accounting system consists of the personnel, procedures, technology, and records used by an organization to develop accounting information and to communicate this information to decision makers. While some of the terms may not be familiar to you at this point in your study of business and accounting, you will be introduced to them more completely as we proceed through this course, and as you undertake other courses in business and accounting. Observe, however, that the information system produces the information presented in the middle of the diagram: financial position, profitability, and cash flows. This information meets the needs of users of the information, investors, creditors, managers, and so on, and supports many kinds of financial decisions such as performance evaluation and resource allocation, among others. These relationships are consistent with what we have already learned, namely, that accounting information is intended to be useful for decision-making purposes. Every accounting system performs the following basic functions: interpret and record the effects of business transactions, classify the effects of similar transactions to compute totals to be used in reports, summarize and communicate the information contained in the system to decision makers. The differences in accounting systems arise primarily in the manner, frequency, and speed with which these functions are performed. In our illustrations, we often assume the use of a simple manual accounting system. Such a system is useful in illustrating basic accounting concepts, but it is too slow and cumbersome to meet the needs of most business organizations. In a large business, transactions may occur at a rate of several hundred or several thousand per hour. To keep pace with such a rapid flow of information, these companies must use accounting systems that are largely computer-based. The underlying principles within these systems are generally consistent with the basic manual system we frequently refer to in this course. Understanding manual systems allows users to understand the needs that must be met in a computerized system. In developing its accounting system, an organization also needs to be concerned with developing a sound system of internal control. Internal control is a process designed to provide reasonable assurance that the organization produces reliable financial reports, complies with applicable laws and regulations, and conducts its operations in an efficient and effective manner. A company's board of directors, its management, and other personnel are charged with developing and monitoring internal control. The 5 elements of internal control are: control environment, risk assessment, control activities, information and communication, and monitoring activities. An organization's control environment is the foundation for all the other elements of internal control, setting the overall tone for the organization. Factors that affect a company's control environment are the organization's commitment to integrity and ethical values, the independence of the board of directors from management, and the board's oversight of internal control, management assignment, with board oversight, of appropriate levels of authority and responsibility, an organizational commitment to attract, develop, and retain competent individuals, and individuals being held accountable for the performance of their control responsibilities. The control environment is particularly important because fraudulent financial reporting often results from an ineffective control environment. Risk assessment involves identifying, analyzing, and managing those risks that pose a threat to the achievement of the organization's objectives. For example, a company should assess the risks that might prevent it from preparing reliable financial reports and then take steps to minimize those risks. When an entity commits fraud, its risk assessment procedures have likely failed. Control activities are the policies and procedures that management puts in place to address the risks identified during the risk assessment process. Examples of control activities include approvals, authorizations, verifications, reconciliations, reviews of operating performance, physical safeguarding of assets, and segregation of duties. Information and communication involves developing information systems to capture and communicate operational, financial, and compliance-related information. Capturing both internal and external information facilitates the flow of information, downstream, from management to employees, upstream, from employees to management, across the organization. All internal control systems need to be monitored. Monitoring activities enable the company to evaluate the effectiveness of its system of internal control over time. Monitoring activities are generally accomplished through ongoing management and supervisory activities, as well as by periodic separate evaluations of the internal control system. Most large organizations have an internal audit function, and the activities of internal audit represent separate evaluations of internal control.